And right now, folks, as we do each and every Tuesday at 3:15 Eastern Time, we're going to talk to our man Basil Chapman. Folks, you can check out Basil's outstanding newsletter, The Opening Call, right there under the newsletters tab at TFNN.com. It comes with many great webinars. We talk about it every time we got Basil on. You can sign up for a month for $149. You can add savings on the 6-month and the yearly, and they all come with a 30-day money-back guarantee, folks. Check that out on the front page of TFNN. Basil Chapman, good afternoon.
Good afternoon, Tommy. How are you?
I'm doing well. How about yourself?
Good, thank you.
So what do we got? Do we got a two-way market? We do a little bit today, Basil. Quite the volatility, man. You got it almost everywhere. Dollar, markets, yields. Where do you want to kick things off? What are you looking at in this market, man?
So, actually, going through the charts and the patterns that I follow all the time and that I talk about all the time, and the technicals that I've always considered important. Let me just go through step by step what we're looking at. Let me start with the middle chart, which is the weekly chart of the Dow. And you can see there's this up channel, beautiful up channel, but it's not good enough that there's just an up channel. It's an up channel. I should also mention that we've been long since the April low, and we've added to that in the interim periods. But most important, you can see that there's a little mini channel right here, pink and green on the upside, and there's this pink support line at the bottom. But most importantly, there's a technique that I've developed over the years, and I use it all the time. It's where the 9-period moving average goes over the 14-period exponential moving average, and it just stays there. Look at this. It keeps you in a trade much longer than your emotions would ever keep you in the trade. Look at this. It keeps going up into that inside track repellent zone. To me, that is so important. And I'd mentioned over actually each week for the past many weeks, I said, look at the way the price just keeps going up to the green line, and then it stalls. And then last week we went just above the green line to an all-time high of 50,512 on the 10th of February. And we pulled back intraday. It was a lousy close on Friday. But look, we're still above the 9-period exponential moving average. So that to me is really important. That's one thing. So I'm talking about a technique that involves a channel. And within the channel, a technique that I refined over the years is to have what I call the inside track propellant-repellent zone. When it gets to the top, does it repel the price or will it break through? And so far, it hasn't become a propellant. So that makes that 50,500 level kind of right now quite difficult to break through unless a couple of things happen. But wait a minute. Another technique that I was talking about was, and I spoke to you about this, I think it was last week, and the week I did the show last week. So it was the week before where I said the volatility index keeps rallying very sharply without the commensurate price decline in the general market. Yes, there's rotation, just as you mentioned, and as we've spoken about before. It's quite selective. It's not everything going up all at once. But look at this. 13.38 was the low of the 24th of December. Since then, look at this daily chart. Look at that beautiful support line. And you've had
pretty amazing. I agree, Basil. Pretty amazing. Yeah, that is quite a acceleration as the market held up. I mean, we were just at 7,000. Feels like yesterday, maybe a couple days,
correct,
right? But yeah, for sure.
And look at this. We went to a high on the 5th of 23.10, a higher high than back on the end of January. We went to 20.29. So we're making higher highs and higher lows, creating a green 9-period moving average exponential positive crossover. That should be very powerful, and yet we're not tanking. And I think that's that in essence is part of the reason. If you look at the weekly chart, if you look at this cup formation and then a second cup formation, and the 9-period moving average went positive last week, and it's still positive, and yet at the same time, the market hasn't pulled back. And that says to me, you've built a cushion. That to me was really important. The reason why we didn't go short, we've kept longs, we want to add to the long position at this point, even though it's very selective, is because I think we've gotten to a general consensus in the, I probably would call it mutual funds and hedge fund managers who are buying insurance and it hasn't worked yet. So I suspect that when this starts to pull back, the VIX index starts to pull back, at some point we'll become vulnerable again. But it's very unusual. Look at this chart on the left, and look at this chart on the left. Same thing I've got now. And what is it? It's the Dow. And look at this. The Dow is almost at highs. I mean, 50,512. We're at 49,000, 1,000 points off, and the volatility index is at one of its not more extremes, but it's at a very high level. So that just says to me, it doesn't mean to say you can't go down, but it's giving you a cushion. So within that context, as I say, for subscribers, we've been very selective. So the Procter & Gamble move that we had, which was going into the XLP, which is the S&P Select Consumer. And let me just show you this. So first of all, here's the Procter & Gamble. 163 was the high 3 days ago. It's just pulling back a little bit. It's had a really nice move from 137 to 163. This is a single leg A in the weekly chart. The technicals have really improved. And the monthly chart doesn't look great, but it has improved a lot. So the XLP, and this kind of speaks to what we were talking about, the selectivity a moment ago. And here it is, Consumer Staples Fund, Walmart, Costco, Procter & Gamble, Coca-Cola, Philip Morris, PepsiCo. It just has the what we used to call the defensive stocks, not defense like Raytheon, but defensive stocks. And it's fascinating that we're going to all-time highs in the general market over the last month, and yet the consumer staples, it used to be the place to go to when the market was really weak. So this is exactly what you were talking about this divergence between the different areas. So we've taken advantage of that. Now, here's another thing that I thought I'd mention. One of the techniques that I've used is where I talk about these three patterns: straight line up, straight line down, cup formation, arch formation, and then a mix of 1 and 2. On the way up, you want to see this green reverse Y pattern taking out the left side high to go to higher highs. On the way down, you've got to be very careful that it doesn't come straight down and fail at a peak A or a B and then take out the left side low. Well, what are we looking at right now? We're looking at, look at the gold. And this is, you and I have been talking about for a little while now, saying that that high that was made at 56.26 back in the end of January came straight down, but we've rallied and then we've arched over. So this arching pattern, the 9 is still over the 14, so that's positive. But you can see it's becoming harder and harder for gold to break into the 5,100, 5,000s is actually arching over. So I've been saying for a while, even though we've kept our core small gold and our core small silver position, I'm watching this very closely because now I'm starting to see the struggle to go to higher highs. But we haven't yet broken down, so it's still holding pretty well. But the pattern that I was looking at, let me show you the pattern again. It's this red pattern with straight line down, then it arches over, fails at a peak A or a B. Where were we? We had peak B just 5 sessions ago, and now we're rolling over. So we've got to be very careful.
Looking pretty close, Basil. It's looking pretty close. I hear you. And you know what's wild, too, is that, and this is my perception, of course, and the volume, and then you add into it, that the volume at the top of that little arch, I don't know if you heard the beginning of the program, but on a weekly basis on gold, that was like one of the lowest volume weeks, and you add up all those days basically at the top of that arch. That was last week. One of the lowest volume weeks we've had in years, not counting holiday weeks. So not only do you do the little arch and you roll over at the top of the arch, it's very light volume, which has me saying, uh-oh, and then you wake up today, you're down $150. Very volatile in both directions, just like the market. But great stuff. And Procter & Gamble. I was looking at Procter & Gamble when you were talking about it. Folks, put Procter & Gamble on a weekly chart. That is some volume there on that run higher, Basil. That is quite a chart. From the whole run, man, right. Every week we've been doing about almost 60 million, 50 to 60 million shares, which is big numbers. So that's quite a run on Procter. Great analysis, man.
Correct. Yes.
Pretty cool.